Interest rates are down. Should you refinance now? It's all over the media. Interest rates are down. Interest rates are plummeting. Interest rates are plunging. Does that automatically mean you should refinance your home loan? Well, first, let's take a step back and look at what's going on with interest rates holistically. Home loan interest rates historically come down when there's something going on in the economy. That could be the world economy, that could be the United States economy, or something big is going on. It could be war, it could be an attack, it could be a pandemic. So let's kind of take a step back to really showcase what I'm talking about here. And this is important, so hang with me. Going into the pandemic, interest rates were still just moving along, kind of, in that mid-5s area. We'd pop up, we'd pop back down, drop down to the low 5s. But that was kind of the zone in those years leading up to 2020. When the pandemic hit, that was it. It was, oh my gosh, the world is shutting down, and the United States government steps in because something bad was happening, right? Something scary was happening over here with the pandemic. They step in, they drop the Fed funds rate, which does not directly impact mortgage rates. Really important, because as we hear in the media, the Fed is expected to drop the Fed funds rate in September of this year. Know that if they drop, let's say, by 0.5%, that doesn't directly mean mortgage rates are dropping by 0.5%. There's other variables that drive long-term mortgage rates or mortgage-backed securities, which is what drives long-term mortgage rates. But I digress. Okay, so the Fed steps in and they drop the Fed funds rate. The yield on the 10-year Treasury plummets. Home loan rates plummet. The Fed starts pushing a ton of money into the economy because we got to keep this thing going. And that's how they did it. As we've moved through the years, all of that money pumping into the economy has had a counter effect, and that's what we're dealing with now. So the rates over the last couple of years have gone up for a few reasons. One, we have inflation, which is like the arch enemy to mortgage-backed securities. We have the Fed increasing the Fed funds rate, which increases other costs. So think about it, just going to the grocery store. I guarantee you, if you're paying attention, which I am, I couldn't believe when I got to the cash out stand over the weekend, I'm like, oh my gosh, that's all I got for this dollar amount? Oh my goodness. So we're seeing every day the impact of rising cost from inflation, from just the overall cost of money. What happened last week though? And this is kind of important as we think about where rates are going. Last week, the jobs report came out. Unemployment is rising. We still have inflationary concerns. We have some things going on in Japan with their economy. All of this comes together and the 10-year yield starts to drop. Now, a good indicator, if you're trying to just know what the heck is going on with home loan rates, watch the 10-year. The 10-year doesn't drive home loan rates, but it's a good indicator and it's very accessible on your cell phone, and you can see if the yield on the 10-year is dropping, that likely means that mortgage rates are dropping. Now, it's, again, not tit for tat. It doesn't dramatically match it, but it's a good indicator. So the yield on the 10-year is dropping, and a lot of that reason also coincided with what was going on in the stock market. So there was a flight to safety, and the flight to safety, not just in this country, but globally, is U.S. bonds. So again, that's driving that yield down, and that helps mortgage rates. The point is, do I think mortgage rates are going to continue to come down? Yes. If you are looking to purchase or refinance, this is a great time to get ready. But understand that they're not just going to go this way. It's going to be like this. So even from the big decrease that we saw last week, and by big I'll say, a quarter to a half maybe in interest rate, depending on the loan scenario, that's pretty big. But this week, rates are kind of back up a little bit. Now, are they back up higher to where we were when we went into that downward trend? No, but they are up. So interest rates are going to move up and down, up and down. They change every day throughout the day. This is just historically the way it is. However, if you purchased a home over the last 2 years and your interest rate is higher than 6%, you want to get ready. Because we know when the interest rates dropped in 2020, do I think that rates this time will get that low? I don't. But it doesn't matter. We have this pent-up demand of a whole population of people that are in home loans greater than 6% now that are waiting on the sidelines to take advantage of lower interest rates. And so my recommendation to you is, if you have an interest rate higher than 6%, if you're paying mortgage insurance, if you have built up equity or have equity in your home that you need to tap into to maybe pay off high interest credit card bills, potentially student loans, pay for a wedding, whatever's going on in your life, it could be a time to get in position. This is really the point, because there is going to be a line, I promise you. And all companies, all mortgage companies across the country are ready, and we have all of our clients, especially the clients we've served, we know what your interest rate is. We know what loan type you have. We're ready. But for those of you that don't have that relationship with your lender, know that we are here. So let's get you ready. We call it the strike zone, right? So if your rate is X and rates fall to here, you got to be ready to lock and load, because you can't take days to consider it. So let's give you scenarios now, walk you through them. What would it look like? Does it make sense? What's your credit profile? Will you be able to qualify? Let's get through all that now. That way, when rates do get to the point that it makes sense for you, boom, that's a strike zone. That's when the rate's locked in. That way you can secure that rate and know what you're getting, because later that afternoon or the next day, they could be back up again. It's just going to be like this. And maybe refinancing your first mortgage, maybe you are under 6%. Maybe you've got a rate in the 3 or the 4s or the 5s. Don't discount that equity and how you can tap into it to help you achieve your goals. So we have a client right now who has a 3.5% on $600,000 loan in first lien position. So a refinance for him isn't going to make sense. He wants to tap into about $80,000. $50,000 of that will pay off credit card debt. Tapping into an $80,000 second mortgage, so it goes in second lien position right behind his current first mortgage at 3.5%. And in that scenario, he's paying off $50,000 in credit card debt. He has $30,000 to use for some renovations that he needs to do on his house. And with that, he is cash flowing every month $700 a month. So, you know, interest rates on second mortgages are higher, but once you look at that higher rate on the second for an $80,000 loan compared to that lower rate on the first with a $600,000 loan, once you blend that together, it's still saving him in comparison to the 28% that he's paying on those credit cards. So you guys, so many different strategies here. This is such a great time just to pause, take a breath, get yourself ready. If you need a strategy or you don't know where to start, just reach out to us. That's why we're here. We look forward to walking you through the steps to get you in the strike zone. So to get on the list, to make sure that you are ready to take advantage of interest rates, whether that's today, next week, or next month, call or text 480-725-0150 or use the scheduling link below, and let's get you ready to save some money or tap into some of that equity that can help you achieve your goals.